Hey everyone, if you started your mutual fund SIP in 2025, chances are high that your returns would be negative. And if you are planning to start your mutual fund journey in 2026, you would find that today almost all mutual funds in the small cap category are showing negative returns in last 1 year. Mid cap returns are either negative or in lower single digit, while large caps are still showing positive return but in lower single digit. Now if you don't understand how mutual funds work, you would probably get confused, because chances are high that you would be expecting 15, 20, 25% kind of yearly returns. But last 1 year returns are negative or not even able to beat FD. So does that mean mutual funds are wrong investments? What is the return expectation you should have from mutual funds? And most important question, how do you build a right mutual fund portfolio in 2026? So if you're watching this video just to know the best mutual funds for 2026, you can skip to the last part of this video. But if you are here to really understand how to build a right mutual fund portfolio, this video can be of great help. Alright, let's get started. Let's first start with understanding most common mistakes people make in mutual fund journey. So one of the biggest mistake is choosing mutual funds purely based on recent returns. Majority of retail investors completely ignore the risk while chasing return. Post-COVID, mid-cap and small-cap segment outperformed the large cap by a big margin. So everyone rushed to buy the mid-cap and small-cap mutual funds. Today, almost all small-cap funds are giving negative return in last 1 year. Again, nothing wrong with small-cap funds. It's just that small caps are inherently more volatile as compared to mid-cap or large cap. They outperform during bull run but also fall more during the correction phase. Similarly, we saw a rush towards thematic and sectoral funds that outperformed in the market. What retail investors don't realize is themes work in cycle, and the worst part is most investors enter these thematic funds after the theme has already performed well, and when the cycle turns, thematic funds underperform. Then second mistake is short-term thinking. Equity mutual funds are meant for long-term goals, yet many people invest with 1 to 2 year mindset. When returns don't meet expectation in the short run, they lose confidence and exit at the wrong time, completely breaking the compounding process. Then third mistake is over-diversification. Let's say you start with 3-4 mutual funds, but over time you watch more videos, listen to new ideas on thematic funds, then come across mutual funds that are outperforming the market. So you end up adding more funds, and by the time you realize you already have 10, 15, 20 mutual funds in your portfolio. This results in over-diversification. And fourth mistake is constant reshuffling of portfolio. As discussed, the first mistake people make is they first blindly chase return. So let's say you started mutual fund investment in 2025 and you bought the funds that outperformed in the last 1 year. But no mutual fund consistently outperform every year. So next year, you realize that your mutual funds are now underperforming. So what you will do is, in 2026, you will end up selling the underperforming fund in your portfolio and buying mutual funds that outperformed in last 1 year. That way you will keep reshuffling your mutual fund portfolio and lose out on compounding. So if I summarize the most common mistakes, first is choosing mutual funds purely based on recent return. Second, investing in equity with 1 or 2 year mindset. Third is over-diversification with 10, 15, 20 mutual funds. And fourth is frequent reshuffling. The big question here is, how do you build a mutual fund portfolio in 2026 so that you can avoid all these mistakes? Let's have a look. The first step of mutual fund journey is to understand yourself before mutual funds. Why are you actually investing your money? What is your financial goal? How much risk can you take? Let me explain this with an example. So let's say you are 25, 30 years old and you start an SIP. At the moment, you don't have any specific financial goal. You just want to grow your wealth. But still, you should have a fair idea when you would need that money. 2 year, 3 year, 5 year, 10 year, when? If you need the money in next 1 to 2 years, you should never invest in equity category. Remember that mistake number 2 that we discussed? If you put your money into equity for 1 to 2 years and the market corrects sharply, it would feel like a bad decision. Not because equity failed, but because your goal and the product did not match. Then another important point is you must understand your risk appetite. The problem is, on paper, everyone thinks they can handle risk. But let's say your portfolio is down 20%. You open your app and you see red and starts bothering you. You check it again next day. Then again you check. Eventually you get fed up and sell your mutual funds. Here one very important caveat is to have a fair expectation of returns from mutual fund. During the bull rally, everyone thought they could fetch 25-30% kind of return from equity market every year. but that's a wrong expectation. Yes, you will see a period when the market will outperform like 25-30% kind of return, but that won't sustain forever. There will be a period of negative return as well, just like we have seen it in last 1 year. So overall, you can expect 12 to 13% CAGR return from equity mutual fund over the long term. I know it does not sound very exciting, but that is a fact. I don't want to show you fake dreams. Although there's a brilliant strategy of how you can increase this return to let's say 14 to 15%. I'll discuss it shortly. So make sure that before investing in mutual fund, you understand yourself, your financial goal, risk appetite, and have a fair expectation from the market. Always keep in mind that markets do not generate linear returns. Equity market is always volatile. But over the long term, you can expect 12 to 13% CAGR return. Once you have the right expectation, market volatility won't surprise you. Now the next question is, how do you fetch 12-13% CAGR return in the long term? That takes us to equity allocation strategy. Once you decide to invest for the long term, you need to shortlist the right mutual funds. Now this is very tricky because today there are more than 500 mutual funds in equity category. How do you identify 3-4 mutual funds for investment? Here majority of people end up making mistake number 1 that we have discussed in the beginning. They simply visit mutual fund website, sort the funds from top to bottom performance and shortlist mutual funds that have generated highest return in last 1 to 2 years. But the fact is there's no mutual fund that consistently outperform the market. In fact, if a fund has outperformed in last 1 to 2 years, there's a high probability that it can underperform now. One of the great example is Quant Small Cap Fund. This fund outperformed big time and ranked number 1 in category for 3 consecutive years, 2020, 21, 22. Then ranked dropped to 7th position in 23 and in 2024 it was ranked 21, one of the weakest performer. Another example is Motilal Oswal Mid Cap Fund. It was number 1 last year in 2024. In 2025 it is worst performer. Here I'm not saying that these funds are good or bad. All I'm saying is that people who chased hype and blindly invested in these mutual funds that generated highest return in last 1 to 2 years have ended up getting totally confused when the fund has underperformed and they are not sure where to invest that money. So they end up stopping the SIP in the old fund and then start SIP in new fund that are doing well at that time. And then the cycle continues. Within 2-3 years, they end up doing mistake number 3. That is over diversification with 10, 15, 20 mutual fund. And they have no clue what to hold, what to sell. So how do you solve this problem? Answer is index funds. By the way, this is not something I'm speaking for the first time. I've covered it multiple times in the past. What is index fund? It's a fund that simply replicates the index. For instance, if you invest in Nifty 50 index fund, your money would be allocated in exact same proportion as per the weightage of the company in Nifty 50. So if HDFC Bank has let's say 12% weightage in Nifty 50, out of 100 rupee, your 12 rupee would be invested in HDFC Bank. Here fund manager is not actively buying or selling stock. Fund manager is simply replicating the index. In my opinion, index fund should form 50 to 60% of your total investment. It means if you're investing let's say 100 rupee, you should put 50-60 rupee in index fund. The big question is why index fund? Because it eliminates the mutual fund investment mistakes. In active fund, you keep comparing your fund with other mutual funds. Index fund completely remove the temptation to chase return. Since there is nothing to compare against, you are more likely to stay invested and let time do its job. Another reason is consistency. Over a very long period, the market itself does reasonably well. For instance, in last 20 years, Nifty 50 itself has jumped 10 times. In last 10 years, Nifty is up more than 3 times. So you don't need to win every year. You just need to participate and stay invested. This is something majority of people can't do with active fund. So index funds solve the behavioral problem of investing. Trust me, it gives you a peaceful sleep because you no longer have to worry about switching your funds. If you have faith in Indian economy and its growth, index fund will take care of your returns. Then another reason to choose index fund is low cost investing. While active fund charges a fee in the range of 0.5 to 1% for direct plan, index fund fee is as low as 0.05% to 0.1%. Although it may look like a small difference, over long term, this cost difference adds up more than people realize. By the way, index funds are also dynamic. It means when a company stops performing well or loses its position, it eventually gets removed and stronger growing companies replace it. The index fund just follow these index changes automatically. So over time, you're not stuck with the same company you bought years ago. The index keep upgrading itself. New leaders comes in, old laggards moves out, you don't have to do anything. And here is the shocking part. Over the long term, very few active funds are able to outperform the index. You simply Google it or ask ChatGPT. As per recent research report, in last 5 years, nearly 90% active funds in large cap category have underperformed the benchmark. In 10 years, 3 out of 4 active funds have failed to beat the benchmark. In mid and small cap also, 81% funds have underperformed over 10-year period. Now there will be argument where fund manager would say Indian market is still inefficient and there's a scope to beat the benchmark. Obviously, they will say that because active funds generate high fee for them. Index fund fee is negligible. And yes, there will be some active funds that will outperform the benchmark at one particular point in time. But what is the guarantee that the fund you invested in would outperform the benchmark over the next 5, 10, 20 years? So make sure that your 50-60% allocation goes into the index fund. Now which index fund? So you have 3 options. First option is Nifty 50 index fund. It simply replicates the top 50 companies of India. You can pick any established AMC. Almost everyone has Nifty 50 index fund. Be it SDFC Nifty 50 index fund, Kotak Nifty 50, SBI Nifty 50. Since all of them are replicating the same index, the risk and returns are more or less similar. Second option is you can consider Nifty 100 index fund. It replicates top 100 companies of India. Again, you can select any established AMC for Nifty 100. Now some people say that they want exposure in mid-cap companies as well that can potentially generate higher returns. In that case, you can opt for Nifty Large Mid-Cap 250. It invests 50% money in top 100 companies and remaining 50% in next 150 companies of India. But note that in investment, risk and return go hand in hand. So this category would be more volatile as compared to Nifty 50. Here you have options like SDFC Large Mid Cap 250 Index and Zerodha Large Mid Cap 250 Index Fund. If you are confused which index fund to pick, simply opt for the index fund that offers the lowest expense ratio. Once you invest 50-60% money in index fund, next question is where to invest the remaining 40-50%. So that can go into the active mutual fund category. Within that, my favorite category is Flexi Cap Fund. The biggest reason is freedom. A Flexi Cap fund manager can move between large cap, mid cap and small cap depending on where they see value. Another reason I like Flexi Cap is behavioral reason. With a single Flexi Cap fund, you don't feel the need to constantly balance between different market cap funds yourself. The fund manager is already doing that job. Now within Flexi Cap, how do you pick the right fund? So I look at the investment style of the fund manager. Some managers are valuation focused, some are growth focused, while some prefer steady compounders. None of them are right or wrong. The question is, can you live with that style when it goes through the bad phase? Another important thing is portfolio churn. If a FlexiCap fund is changing its holding too frequently, that's a red flag for me. Flexibility does not mean constant action. Good funds make fewer high conviction decisions. And finally, look at the long-term track record, not just return. Has the fund survived different market cycles? Has it protected downside reasonably well? Has it stuck to its philosophy even during tough periods? Considering all these factors, my all-time favorite FlexiCap fund is Parag Parikh FlexiCap Fund. I absolutely love their investment style and I'm totally inclined with their style. And second fund I like is HDFC FlexiCap Fund. Again, it has years of established track record of great performance during both good and bad times. Personally, I would say you can invest remaining 40-50% in FlexiCap category. So 2 index fund, 2 FlexiCap fund, that's it. You're sorted for life. But the only catch is index funds are too boring and the majority of people need excitement. Even FlexiCaps have higher exposure in large caps. So those who want some excitement, they can deploy let's say 50% index fund, 30% in FlexiCap fund and remaining 20% they can divide 10% in high risk category like mid cap fund, small cap fund and 10% in thematic fund. For thematic fund I like 3 themes at the moment: capital market, internet or digital companies of India and even defense is a great theme. I've recently done a video on these themes. For mid and small cap, I like SDFC mutual fund and Kotak mutual fund investment style. So you can choose any of the mid cap or small cap fund from these fund house. Also, I'm closely tracking new AMCs like Helios, White Oak and Old Bridge. You can explore their fund as well. Once you shortlist the mutual fund, the next question is, what should be your investment strategy? Let's have a look. When it comes to mutual fund investing, the strategy is surprisingly simple. The hard part is sticking to it. First, think of SIP as your default mode. Not because it gives the highest return every year, but because it removes the emotion from the process. You invest when the markets are up, you invest when the markets are down, and you don't have to guess anything. Over time, this discipline matters more than timing ever will. Now understand one thing very clearly. Returns will never be linear. There will be years when nothing seems to move. There will be phases when your portfolio goes nowhere or even fall. That's not a failure of the strategy. That's just how equity works. This is where expectation play a big role. If you're expecting steady, smooth return every year, you're in the wrong place. You may want to do an FD. If you expect volatility as a part of the journey, you'll be much calmer. In fact, you should embrace volatility and make it your friend. You remember I said overall you can expect 12-13% CAGR return from equity mutual fund, but there's one strategy that can increase your return to, let's say, 14-15% CAGR. That strategy is short blast SIP or top up SIP. It means whenever the market corrects, let's say 4-5% or let's say 2-3%, you deploy some more money. I know it's not easy to do it because when market is falling, people panic. They don't have courage to buy. But trust me, if you can control your emotion and simply follow this strategy of top up SIP on every, let's say 4-5% correction, 2-3% correction, you can increase your overall return from the market. But this works only if your base strategy of SIP is already in place. Random lump sum without any long-term plan usually create confusion. So if you step back and look at everything we discussed, one thing becomes very clear. Mutual fund investing is not difficult. What makes it difficult is the unrealistic expectation and constant indifference. People enter expecting 20-25% return every year, and when markets don't cooperate, they start questioning everything. The fund, the strategy, even the idea of equity investment itself. But equity was never meant to perform every single year. It meant to work over time. If you can get three things right, understanding yourself, keeping a simple portfolio, and following a basic SIP discipline, you don't really need to do much. You don't need to predict market. You don't need to reshuffle every year. You just need to stay invested long enough. Index fund gives you stability. Flexicap fund gives you flexibility. SIP gives you discipline, and patience ties everything together. That combination may look boring today, but boring is usually what works in investing. So if you are starting in 2026, don't worry about timing the perfect entry or picking the perfect fund. Focus on building a process you can live with, even during the bad years like 2025. Because in the long run, mutual funds won't reward intelligence, they reward behavior. Okay, let's not stress this video further. I've tried to share everything in my best of knowledge with 100% honesty. I hope you find this video useful and it gives you that direction. In case you like it, do share it within your circle. I'll see you next video. Till then, take care.